Hello, I'm Nathan Kubik, and thank you for joining us for the third quarter of 2018 Carnegie Kubik Capital Markets Outlook. Today, we'll be discussing recent events, what we are currently observing in the financial markets, as well as a number of other noteworthy influencing factors moving forward. After a discussion on potential impacts from those factors, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. Following the volatility seen in the first two quarters, the markets powered forward this past quarter. The S&P 500 increased by 7.7% in the third quarter, which is more than 70% of the year-to-date's return. This performance can be primarily attributed to the impressive top-line and bottom-line growth coming on the heels of the recent tax reform. Those impacts from tax reform, along with the implications from ongoing interest rate hikes and tariff war discussions, continue to be the leading influencing factors in the markets today. We have entered a cycle where companies beating earnings expectations are being rewarded, and those missing those expectations are being punished. New data related to tariffs and to rate hikes are being quickly and easily digested by the markets. While the domestic markets don't appear concerned with the implications of those two factors, it is important to understand that there are potential risks. Inflation continues to remain at low levels, but it is a variable that we are monitoring closely due to its direct exposures to tariffs and to that of interest rates. The new variable that we will contend with this quarter is that of midterm elections. We are not currently positioning in anticipation of any dramatic economic policy shift. Currently, there are two likely potential outcomes. The Republicans remain in control, or the Democrats take control of the House. Historically, a split Congress results in a political gridlock, which usually means very little change. And because the financial markets love certainty, this gridlock is typically a good thing from a historical markets perspective. Domestically, our economic expansion has continued, and we have been greatly rewarded within the U.S. equity markets. In this chart, the S&P 500 performance is depicted by the gray line, and the rest of the world is depicted by the purple line. As you are no doubt aware, we have had very little international equity exposure these past years. Ultimately, we had chosen to limit this risk exposure as a result of the greater quality of our economic recovery and expansion compared to that of other countries. In addition to the U.S. being more attractive from a relative economic growth standpoint, the strengthening dollar and the implications of a tariff war have further boosted the attractiveness of the U.S. equity markets. That is not to say that the trade war doesn't have implications on domestic companies as well. In looking at the chart on the left, we can see that executives of S&P 500 companies are speaking to the potential implications of those tariffs on their company's quarterly earnings calls. What happens next with the tariff discussion is unknown. There is the risk of escalation, and while we hope that is not the case, it is certainly a possibility. Fortunately, in regard to China, we remain in a much better negotiating position. As you can see, of the items we import from China, we are yet to tax about half of them, whereas China has already taxed about 80% of what they import from us. Another way of looking at this is that we have another $201 billion in imports yet to tax, while China only has $29 billion worth yet to tax. Wrapping up the discussion on the U.S. compared to other areas in the world, we wanted to show the performance of each region over the last quarter, year-to-date, and trailing 1 year. The U.S. has outperformed by a significant margin. Another interesting chart can be seen in the upper right of this slide. This chart shows us the percentage weightings of the different regions in the MSCI All Country World Index. As you can see, the U.S. makes up about 55% of the global market capitalization. China is actually considered an emerging markets country and contributes about 3.4% overall to this index. Leaving the international discussion aside and focusing domestically, we recognize that corporate profitability is continuing to grow at an impressive pace. In the most recently reported trailing 12-month financials, we saw a net profit margin growth of about 14.7% and revenue growth of 10.7%. These are tremendous levels of growth. Based on the consensus of analysts, it is expected that this growth will continue and that the impacts from tax reform are continuing. The growth is a primary reason for the performance we have seen in the domestic equity markets. In addition to the strength seen from an equity market perspective, domestic economic indicators continue to build positive momentum as well. Unemployment levels are well below their historical averages, so low in fact that we were surprised to see how long it took for wage growth to tick upwards. Given the low levels of inflation, a slower wage growth rate was anticipated. However, we have been expecting that the limited labor pool would result in companies' willingness to pay more to fill their needed positions. This is now beginning to occur in a more apparent manner. This continued growth has resulted in higher equity prices. Remember that the S&P 500 increased by about 7.7% this past quarter. So does this mean that the valuation multiples increased by the same amount? The answer to this is no. Forward price to earnings multiples increased by about 4% this period. The rest is attributable to the past quarter's impressive earnings per share growth. The increase in the valuation multiple is explained by the market's expectation of further earnings growth in the near future. Indicators do appear to support this expectation, and valuations remain relatively near historical averages. Should the consensus of analysts be correct regarding earnings expectations, then the equity markets should benefit in the quarters to come. In considering style investment positioning, we continue to see a market cycle dominated by growth-oriented companies. Growth companies are driving the revenue and earnings discussion that we've been having today, and are thus justly being rewarded more so than that of value companies. This trend has been in place for more than 5 years now, and we are continuing to overweight growth companies to that of value. I should note that the difference in 2018 thus far is quite dramatic. Large cap growth companies recognized a 17.24% year-to-date return, where large cap value companies only recognized 3.51%. What's even more interesting is that after such a deviation in performance, the valuation metrics of growth over that of value are not that far from historical averages. In the large cap space, the relative growth valuation multiple is slightly greater than that of value, but to a degree that's quite justifiable given the earnings trends. Small cap, on the other hand, is a different story. We added some small cap growth exposure earlier this year to position for the tariff discussions. We still feel that this weight is warranted. However, in our opinion, within this style, valuations have reached an inflated level. As we have some short-term gains within the style, and because momentum remains strong, we will watch this style closely and reduce exposure as warranted. Continuing the style discussion at a more granular level, growth-oriented sectors continue to be among the top performers. The best two performing sectors in 2018 have been the growth sectors of consumer discretionaries and technology. Remember that there was a shift in the holdings composite of 3 sectors this past quarter. All of telecom, 20% of technology, and 24% of discretionaries were moved into the new sector of communication services. As a result, some of these returns in the year-to-date column have been impacted. Ultimately, there is a meaningful dispersion of returns that coincides with the dispersion seen within the style returns that we just discussed. I will note one meaningful momentum change that has occurred within the healthcare sector. If you recall, we moved from a large overweight in 2015 to a large underweight in 2016. This was due to a shift in market momentum and not necessarily a financial fundamentals shift. In 2017, we moved back to a market weight with a desire to move to an overweight. The sector looked attractive from both a quantitative and qualitative standpoint, but we didn't want to fight the markets as momentum was yet to shift. Earlier this year, we had a slight overweight to healthcare, and we've finally seen what appears to be a shift in momentum. To that end, we've added additional exposure, and healthcare is once again officially an overweight. Here, we look at the weights of the S&P 500 and that of our core equity model. As you can see, we are currently overweight in financials, technology, healthcare, and consumer discretionaries. It just so happens that these are the 4 largest sectors within the S&P 500, and with the exception of financials, are having a very strong year. While financials are lagging thus far this year, we are maintaining this overweight with the expectation of further rate hikes and an eventual steepening of the yield curve. We are underweight in utilities, real estate, and materials. The reason for these underweights are that each of those sectors looks less attractive from a valuation, momentum, and thematic standpoint. On this slide, we look at the current tactical weights of our dividend equity model compared to that of the S&P 500, as well as our own internal long-term strategic target weights. As we've discussed in the past, this model's focus on increased stability within the equity markets results in a slightly different sector allocation than that of our core model. Additionally, with the creation of the new communication services sector, we have updated our target sector allocations. While these target allocations are different from the core model, you will notice similar over and underweights to that. Technology, discretionaries, financials are again our largest overweights, and consumer staples, utilities, and real estate are our underweights. We are also underweight communication services in the dividend model. This is primarily due to the extremely diverse group of holdings within this sector and our stringent fundamental screens set forth by this model. In this model, we will continue focusing on strong fundamentals and dividend growth. The interest rate environment has shifted slightly over the last quarter. The Federal Reserve raised the short end of the curve by 0.25%, and it's expected to do so one more time in 2018. As we discussed last quarter, we believe it is unlikely that the yield curve would invert. Instead, we have been expecting that rate hikes will push the entire yield curve higher and offer more attractive bond yields. With the most recent rate hike, the entire yield curve did move higher and bond yields are more attractive. However, the yield curve is actually even flatter than it was last quarter. The economy continues to gain momentum, which should also encourage a higher rate environment. With the yield curve being extremely flat, we see no reason to take on any additional interest rate risk by extending bond durations. Instead, we as lenders are now being rewarded at a greater rate to be patient and wait for rates to move higher. On the other hand, the borrowers, or bond issuers, are extending their durations and locking in bond rates today with anticipation of greater interest rates in the future. Similar to a homeowner locking in a longer-term mortgage when rates are low, bond issuers have been taking advantage of the low interest rate environment that we have been in. This can be seen when looking at the gray line in this chart, which represents the average duration for the U.S. bond market. As you can see, U.S. bond issuers have extended their duration rather significantly over the last several years. This, combined with corporate capital expenditures, could be seen to imply that they too have confidence in where the economy and thus the markets are heading. In conclusion, our cautiously optimistic outlook has been partially substantiated this past quarter. And while the many positive economic indicators give us reason to feel encouraged about where the markets are headed, it is critical that we remain focused on potential risk exposures that could derail this ongoing expansion. Tariff discussions remain at the forefront of potential risks, but there is always the risk of a black swan event. While we are always positioned to react to the ever-changing conditions within the markets, we believe that the U.S. markets continue to be stronger than the rest of the world, and that the items we've discussed today indicate continued economic growth. We are continuing to position our portfolios in effort to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional or clarity on the information presented. Take care, and we look forward to speaking with you soon.